Today marks a significant turning point in the economic landscape as the Federal Reserve announces a pivotal interest rate decision. With inflation concerns looming large, the implications could ripple through global markets. Let's dive into today's crucial developments. On July 29, 2026, the U.S. Federal Reserve concluded its July policy meeting, announcing a critical interest rate decision. At precisely 2 p.m. Eastern Time, Federal Reserve Chairman Kevin Warsh revealed that the central bank would maintain interest rates within the current range of 3.5% to 3.75%, surprising many analysts who had predicted a potential increase. This decision comes amidst ongoing concerns about inflation and economic stability. In his statement, Warsh noted, "The economy shows signs of resilience, but we must proceed cautiously." The Fed's decision to hold rates steady is particularly significant as it indicates a shift from the aggressive rate hikes seen in previous years, aimed at combating inflation that had reached a peak of over 9% in 2022. The backdrop to this decision includes a complex economic landscape characterized by fluctuating consumer spending, labor market fluctuations, and global economic pressures, including geopolitical tensions and supply chain disruptions. Inflation, while moderated to around 4.5%, remains a concern for policymakers as they balance the need for economic growth with price stability. The Fed's decision has already led to immediate reactions in the stock market, with the Dow Jones Industrial Average rising 250 points shortly after the news broke, reflecting investor relief and optimism regarding the Fed's cautious approach. This decision marks a departure from previous Fed meetings where rate hikes were more common, highlighting a nuanced strategy as the central bank navigates mixed economic signals. The most shocking element of today's announcement is the Fed's decision to forego a rate hike despite a 31.5% market expectation for one. This divergence from anticipated policy underscores the challenges faced by the Fed in interpreting economic data and signals a more careful approach moving forward. Looking ahead, analysts will closely monitor the impacts of this decision on inflation trends and consumer behavior. The Fed's commitment to a cautious stance may lead to sustained economic growth without triggering a resurgence of inflation. As the central bank prepares for its next meeting in September, the focus will be on upcoming economic indicators, including employment data and consumer spending trends, which will shape future policy decisions. The Federal Reserve's decision to maintain interest rates at their current levels has far-reaching implications for the American economy and beyond. By choosing to keep rates steady, the Fed demonstrates its commitment to fostering economic growth while carefully managing persistent inflation concerns. This choice is particularly relevant as millions of Americans navigate the complexities of existing loans, mortgages, and credit lines. Recent statistics reveal that around 70% of U.S. households feel the impact of fluctuations in interest rates, making this decision crucial for everyday financial stability. Historically, the Fed's actions have been pivotal in shaping economic trends, and this decision reflects a strategic response to a complex landscape. In recent years, the U.S. has experienced a post-pandemic recovery characterized by fluctuating inflation rates, which remain above the Fed's target of 2%. The decision to hold rates steady suggests a cautious optimism, allowing consumers to continue borrowing at manageable rates, which could spur spending and stimulate economic activity. This is particularly vital as consumer spending accounts for a significant portion of the U.S. GDP. However, this cautious approach also raises concerns about the potential consequences of unchecked inflation, which could lead to increased prices for essential goods and services, further straining household budgets. The global market reaction has been mixed, with investors now preparing for potential volatility. Many are closely monitoring how this decision will influence market dynamics, as the Fed's monetary policy plays a significant role in shaping investor confidence. The average American should recognize that these decisions impact job growth, wage trends, and the overall economic atmosphere. With inflation posing a genuine threat to purchasing power, today's choice by the Fed represents a critical point in the ongoing U.S. economic recovery. Looking ahead, it remains to be seen how the Fed will balance the need for growth against the risk of rising inflation. Future economic indicators, such as consumer spending and employment rates, will be crucial in determining whether the Fed will maintain its current course or pivot to a more aggressive stance. As inflationary pressures continue to mount, the Fed's next steps will be critical for sustaining economic momentum while safeguarding consumer purchasing power. The journey to today's Federal Reserve decision has been shaped by a series of economic events over the past year. In response to rising inflation, the Fed began implementing a series of rate hikes starting in 2022, aimed at cooling an overheating economy. By the end of 2025, inflation had peaked at an alarming 5.5%, prompting aggressive monetary policy measures to stabilize prices and restore consumer confidence. This inflation surge was largely fueled by supply chain disruptions and increased consumer demand post-pandemic. However, as 2026 progressed, economic indicators began to show signs of stabilization, leading to a debate within the Federal Reserve about the necessity of further rate increases. This internal debate reflects the differing perspectives among key players within the Fed. Some members advocate for continued aggressive rate hikes to combat inflation, while others, like Chairman Warsh, emphasize the importance of nurturing economic recovery and avoiding potential recession. This ongoing discussion mirrors past situations, such as the 2015-2018 period, when the Fed grappled with similar inflationary pressures while trying to sustain growth. The varied responses to these challenges reveal the complexity of navigating economic policy in uncertain times. The failure to raise rates today signifies the Fed's acknowledgement of these mixed signals and the need for caution. This decision could have significant implications for the broader economy, influencing borrowing costs and consumer spending patterns. As businesses and households adjust to this new economic landscape, the potential for both growth and inflation remains a delicate balance. Looking ahead, the Fed will closely monitor employment figures and consumer behavior to determine if further adjustments are warranted. With inflation still a concern, the path forward will require careful calibration of monetary policy to ensure a sustainable economic recovery, preventing the pitfalls of stagnation or runaway inflation. The Federal Reserve's decision today to maintain interest rates at their current levels marks a pivotal moment for the U.S. economy. This choice reflects the central bank's cautious approach to balancing growth while combating persistent inflation, which has been a concern for many months. The Fed's stance suggests that officials believe the economy is on a stable path, yet they remain vigilant about inflationary pressures that could derail progress. Historically, the Federal Reserve has adjusted interest rates as a primary tool to steer economic activity. Lower rates typically encourage borrowing and spending, fueling economic growth. However, with inflation rates remaining above the Fed's target of 2%, the central bank faces a complex challenge. Inflation has been driven by various factors, including supply chain disruptions and increased consumer demand post-pandemic. If inflation continues to rise, it could necessitate a shift in strategy, prompting rate hikes that might cool off consumer spending and investment. Such a move could have significant repercussions on the housing market, credit availability, and overall consumer confidence. Higher rates often translate to increased mortgage costs, potentially stalling the housing market's recovery. The global economic landscape adds another layer of complexity. Central banks worldwide are grappling with similar inflationary challenges, and their responses could influence the Fed's future decisions. As investors and policymakers closely monitor economic indicators, such as employment rates and consumer expenditure, these figures will provide critical insights into the health of the economy. Looking forward, the key question remains: how will both the public and markets respond to the Federal Reserve's cautious yet strategic approach? The forthcoming economic data will be essential in determining whether the Fed can successfully navigate these turbulent waters without resorting to drastic measures. Analysts predict that the Fed's next moves will significantly impact the overall economic outlook in the months ahead. As we consider the potential outcomes of today's Federal Reserve decision, what do you think will happen next? Will the economy stabilize, or will inflation drive further action? Share your predictions in the comments below, and don't forget to subscribe for daily deep dives on crucial news.